Welcome back. If you just joined us, this is Taking Stock. I'm Pim Fox. Time to listen closely. My next guest says he can predict some market movements before they happen. And judging by his 2008 predictions, deflation, a bear market, well, he might be onto something. Now he thinks a new year is going to usher in a big buying opportunity. Charles Nenner runs the Charles Nenner Research Center and is also a professor at Touro University. And also I have Malcolm Polly. He also thinks that the stock market is near a bottom, but he isn't sure exactly when we're going to have that big rally. He's the Chief Investment Officer with Stewart Capital Advisors. Gentlemen, welcome, and nice to have you. Nice to have you, Malcolm. Good to have you back, Charles. So tell me, what are your indicators telling you? Because frankly, I thought that the last time you were on, you were telling me, get set for the big rally. Right. What happened to our big rally yesterday? It happened already.
No, we're getting there for the big rally. What happens now is, what is a big rally? You can make 15% in 1 or 2 days. That's what you usually make in a year. You probably want to know when it's a bit longer term range, it goes in one direction.
Give us a little bit of a hint so that you don't need such a cast iron stomach to deal with this.
What my cycles show. My cycles show that all these crazy moves should be over by the end of the year. Then you have a substantial up move into April, May. But then you go down one more time to new lows. And only then it's over. So it's,
when you say over, this means
the
bear market is over.
Well, it depends how you define a bear market. But then you can see a rally of 100% or more. Just the buy and hold strategy that was proposed for many years doesn't work anymore. People should forget about that. So market timing becomes a very important tool these days.
But what about the people that say, as particularly retail investors, they're great at timing the market, except they do it at the worst, in the worst way. They tend to sell when they shouldn't sell and buy when they shouldn't buy. So what should people be doing? Should they be accumulating cash now for a rally that will take place in the new year and therefore be buying in the first week of January? Or how should they be positioning themselves?
First of all, if in the market, don't go out anymore because they're going to be close to a low. So you don't want to go out anymore.
So don't sell anything right now if you have a portfolio of equities.
If you intend to go into the market, do it in January, in the new year. If you have a sizable rally like I expect into April, May, then you really want to go out because after that you see one more leg down.
Okay, so January for the buy signal, and then April or May
for the
get out, and then wait and see what happens.
Late in the year, you'll see a serious drop, and then again you can go long. The problem with the retail investor is always on the wrong side. If one time he would get out at the top, he would have the strength emotionally to get in at the bottom. But since he never get in tune with those markets, he's always on the wrong side. So we'll try to get him now on the right side, which means if you want to buy in January, and even if it does very well, you think we go into the sky again, get out in April, May.
All right, so we're going to have to build a little emotional stamina here for just a moment. Let me come to you, Malcolm. Maybe you can help us do this kind of construction work. What leads you to believe that we may be nearing a market bottom, and do you sort of sympathize with what Charles is describing?
I guess to start with what Charles is describing, I guess I do sympathize a little bit, although it does make a certain amount of sense. You do tend to get a January effect, so it makes sense to get in January. You do have the old trading saw, sell in May and go away. Again, that makes a certain amount of sense. We take the opposite side of his viewpoint that buy and hold doesn't work. We've been buy and hold investors a long time. That doesn't mean you do it in a box. We don't buy the market, we buy companies, we buy businesses, and we want to buy good businesses. And we think that you're at points in a market where valuations are very attractive for a lot of things. You're at a point where corporate bonds are competing very well with equities. If your time horizon is longer than a year, then it makes sense probably step into some equities that have dividend yields to allow you to at least participate in some of the cash flow that the corporate bonds are providing you.
All right, but let me ask you right there, just in terms of dividends. Sorry to interrupt, but I just want to ask you, what happens if, for example, we see corporate earnings deteriorate in the fourth quarter, even in the first quarter of 2009? They could be slashing those dividends, so that's not so safe.
And I would expect that earnings in the fourth quarter will probably look so good, and the first quarter probably will not look so good. So for us, the key is balance sheet. Balance sheet, balance sheet, balance sheet. We like companies that have a clean balance sheet, that can fund themselves internally, that don't need a lot of debt or have no debt on their balance sheet. So if earnings come down by 30–40%, if you're buying a stock with a 4 times multiple, so what? You get cut in half on earnings. You got an 8 multiple on the stock. It's still not extended.
Okay. All right. Malcolm, stay with us. Charles, stay with us. We're just going to take a quick commercial break. When we come back, I'm going to ask Malcolm about fertilizer stocks and also healthcare. And when we also come back, we'll talk to Charles, find out how does he gauge market sentiment? What tools is he using to figure out where the market's going? We're coming right back. This is Taking Stock on Bloomberg. Welcome back to Taking Stock. My guests, Charles Nenner. He runs the Charles Nenner Research Center, and he's a professor at Touro University. We also have Malcolm Polly. He's the Chief Investment Officer with Stewart Capital Advisors. Now, Charles, I know that you were listening to what Malcolm was saying about buy and hold, albeit everyone gets their own thoughts in this. Tell me, what's your reaction to that? You're looking back into history.
Yes, I remember. I don't know exactly the numbers because not prepared, but I remember looking at stocks at the high of 1929 before the crash. It took them like 30, 40 years to get back to the same level. Not even talking after inflation, even before inflation. So you have a problem with buy and hold. We really have to do a lot of studies in the long term, in most cases, if it's really good to buy and hold.
But isn't the whole issue about buy and hold is that no one's really smart enough to time the market?
Right.
So as a result, you've got to buy and hold if you want to be in the stock market.
Right. So we don't do buy and hold. Like now, we're playing 50% up, 10% down, 50% up. So the real question to my neighbor is, if you know how to time it better, would you also do buy and hold? Or is just a lack of tools at the moment? So he says, okay, let me buy and hold it because I cannot do anything else.
Because there's no alternative.
It's not so much that I don't have anything else to do. It's a matter of, again, I don't buy the markets. I really don't care what the market's doing. I don't care if the market's overvalued or undervalued because I'm not buying it. I'm buying businesses.
You're buying individual stocks. For example, you're interested in fertilizer stocks right now. You like Mosaic? You like potash?
We like a lot of the fertilizer companies. And the theme that you get invested in is, you get interested in is that on a global basis, as the economies of the globe expand, the need for protein increases, whether it's animal or plant protein. The fastest way to increase plant production and animal production, for that matter, and the least expensive way is through fertilizer.
Okay, now I know that, but I mean,
Right.
is this a situation where how long are you going to buy and let's say hold Mosaic? Because I read yesterday, Mosaic came out and said we're cutting back phosphate production because the demand just isn't going to be there.
For short term, I agree that there may be issues within the next year or so. But again, if I'm buying Mosaic at 5 times earnings, and if I'm getting a decent dividend yield, I don't care if earnings get cut in half.
Okay, because you got a longer time horizon.
I've got a longer time
I'm looking at those stocks. I looked at those stocks. Those stocks usually start moving 4, 5, 6 months after the commodities start moving. So actually you have to know then when corn, soya beans, and wheat are bottoming. Is that something that your firm knows? Otherwise you don't know when the farmers are going to buy fertilizers.
Most base commodities move with the global economy. We know the global economy is sliding into recession. So it makes sense that prices for most commodities would continue to fall. I wouldn't expect that would not continue for the next 6 or 9 months. But again, I don't care about the next 6 or 9 months. I'm looking 2 years out, 3 years out, 4 years out, when I know those issues are still in place, and we should do just fine.
Okay, now unfortunately we are out of time. I want to bring you back, both of you, because we've got to resolve some of this. I know you want to talk more about Brazil and where people should be putting their money in specific terms.
Right.
Thank you very much, Charles Nenner, Malcolm Polly. Thank you very much, gentlemen. We are out of time, as I said. Please send those emails, pfox11@bloomberg.net. Bloomberg's Evening Edition is coming up next. Thanks for taking stock. I'm Pim Fox. Good night.